Hey guys, welcome back. In a previous video, we broke down a couple of examples of a short-term rental in a city like Nashville, Tennessee, and broke down the type of cash flow or the amount of dollars that we could make in bookings or revenue per month or on an annual basis. And today we wanted to talk a little bit more in depth on what that cash-on-cash return or total return on our investment truly looks like. And in our two examples, we estimated our return to be $30,000 a year in net profit or net cash flow on the higher end. And in the second example, we talked a little bit more to one that was struggling a bit and only netting around $3,996 a year, again on the lower end. And that is a drastic difference. Now, in the first example, that breaks down to about $2,500 a month, where in the second, only $333 a month in cash flow. So you might be saying, it's still profitable, isn't it? And while the short answer is yes, there's certainly a little bit more to it than that. Now, I say this because in a city like Nashville, for a property that sleeps 12 to 16 guests, will have to be a minimum of 4 bedrooms and relatively close to downtown, where the main attractions are and the music and the bar scene is here in Nashville. So in order to achieve that $1,000 a night on the weekends that we were calculating in order to achieve the dollar amount cash flow on a monthly annual basis, a property of this magnitude will likely sell for a bare minimum of $500,000. So let's assume you put 15% down on that house, which comes out to be around $75,000, and it costs you, let's say, $25,000 to furnish the house. So these are nice round whole numbers. I use this for example's sake, but these would probably be fairly accurate numbers here. And that would be a total of $100,000 investment up front. Now, something you hear all the time is that the stock market averages 10 to 12% rate of return on an annual basis, right? So in order to match or beat this as a real estate investor, what we're shooting for is a greater than 12% return on our investment. So the first metric that we seek as real estate investors for rental properties is cash on cash return. And this is exactly how it sounds. The total net cash flow or profit we make in a given year from the revenue earned from our bookings minus our expenses divided by the total amount of money invested up front. So let's go back to our examples from the last video. So to calculate our cash on cash return, we take our net cash flow for the year and divide it by the total money invested up front. So we will take the $30,000 that we made and divide it by our initial investment of $100,000, and this gets us to a 30% cash on cash return. That sounds great, right? Well, it is. And honestly, it's not abnormal in a market like Nashville to achieve this rate of return on a cash-on-cash basis for a short-term rental. Now, the second example, we'll do the same math. We'll take our $3,996 in cash flow for the year and divide it by the same $100,000 investment up front. And we get a measly 3.996 or rounded up to 4% cash-on-cash return. Now, the first example would absolutely be well worth it looking at it on a cash-on-cash basis. And the second example would not. You'd be better off putting your money in the stock market and achieving somewhere between a 10 and 12% rate of return. Now, longer term, it's more important to take into account other factors outside of just the cash that we're receiving each month from bookings, right? So in order to calculate this, we're going to look at total return on investment. Now, what do I mean by this? Well, we take into account not only the revenue or cash flow earned, but also the loan or principal pay down and the appreciation of the property itself. This will give us a true or total rate of return on our investment. Now, as the majority of our calculated monthly expenses is going toward our mortgage costs, a portion of that is principal pay down. So if you're not familiar with how an amortization schedule works, over let's say a 30-year fixed loan, each month, you're paying a portion of that is going toward the interest accrued by the bank. So you're basically paying the bank in order to use their money to buy the house. And then a small portion of that is going toward the actual principal amount in the house or equity in the house. Now, over the course of the loan, the interest amount paid each month goes down while the equity or principal paid down on the house goes up. Now, the banks are smart, of course, and do this so if, in case you pay the loan off early, the bank will recoup the majority of their interest costs up front. Okay, so as long as you're at least breaking even each month, you can also take into account our principal pay down on the house, which is essentially just money being deposited in the bank for you. Okay, so breaking down this example further, if we put down 15% on a $500,000 house, let's assume our interest rate is around 4.6%. And now interest rates will fluctuate over time, up and down, even on a daily basis. And they're generally quite a bit higher for an investment property than for a primary residence. So if we take a look at an amortization schedule, the first 12 months of our mortgage payments, our principal amount paid down starts out around $500 a month. Now remember, this slowly increases over time each month. For example's sake, we'll just use a flat $500 principal amount each month for the first 12 months just to calculate our total return on investment. This adds up to $6,000 a year in equity in the house, paid for by the bookings paid by your guests. Now this is on top of our net cash flow or revenue received from bookings on each month or each year. So we're not done yet because we need to take into account the appreciation as well. Now over time, the value of your property will likely increase, especially if it is located in a growing city such as Nashville, which is being flooded with new residents every day and an increased amount of visitors each year. Now the historical average home appreciation varies, right? So you'll hear often between 3 to 5% a year of appreciation, and that depends on what data sources you're looking at. Are you in a metro area like Nashville or a less populated area out in the suburbs somewhere? But for a conservative estimate for this example, we will use a 3% annual home appreciation for our first year, even though in reality, in a bull market like we are in today, it might be quite a bit higher than that. Now remember, our house in this example was originally purchased for $500,000. Assuming 3% appreciation, we take 3% of $500,000, which gives us $15,000. So we can assume in just our first 12 months of owning the rental property, the house value is now conservatively estimated to be around $515,000. So let's add all this up. In our first example, remember, we made $30,000 in net cash flow for the year, $6,000 in principal paydown, and $15,000 in equity from appreciation. This adds up to $51,000. Now, to get our total return on investment, we take this number and divide it by our initial investment, as you may recall, was $100,000, bringing our total rate of return on the investment for the first year to be 51%. That's insane. Now, we haven't even talked about tax benefits or other benefits of owning real estate long term. So now let's go back to a much more conservative estimate. Now, based on our second example of a rental property, that might be struggling a little bit for various reasons. But assuming that the same property value, loan estimates, and monthly expenses, etc. However, we calculated our net cash flow for the year to be only $3,996. So what would our total return on investment be? We will again assume the same principal pay down on the loan and home value appreciation of 3%. For the year, we'll take the $3,996 in rental income, $6,000 in equity from principal payments, and $15,000 in equity built from appreciation of the property. Now this brings us to a total rate of return around $24,996 for the year, or roughly 25% total return on investment. Now, looking at the big picture, in either example, over the course of the loan, once the house is paid off, you now have the original $500,000 in equity in the house, plus however much the house is appreciated, right? So once the house is paid off, we drastically reduce our monthly expenses because now we don't have to be paying the principal or loan down on the house to the bank. Okay, so now you can see over the long term how owning real estate and owning a property that's cash flowing can drastically compound and continue to increase over time. You take the dollars earned and reinvest into other properties, and it grows, and that's your nest egg right there. So I know what you're saying. I don't have $100,000 to invest in real estate today. And while, okay, that's true, and most people don't, and that's totally okay. Everyone's got to start somewhere, okay? I use this example because the numbers are even and easy to follow along. They're realistic. And what's cool is you can do the same calculations for other properties achieving the same rate of return, right? So we can break down further examples in future videos, but everyone's got to start somewhere. So I hope you enjoyed this video, and if you have any questions or comments, please leave them below. Throw me a like if you enjoyed it, and we'll see you next time. Thanks. Bye.